Most retirees run the wrong calculation before they claim Social Security. The answer the calculator returns is mathematically correct. The equation is missing two of the three costs that determine whether waiting actually paid off. By the time most people find the gap between what the calculator showed and what the plan actually cost, the filing is already locked. Here is what the calculation is not including. Dennis, 63, a retired civil engineer from Columbus, Ohio, spent nearly a month running numbers before he decided when to file. He used a free online calculator. He entered his benefit at 62, his projected benefit at 70, and a life expectancy of 84. The calculator returned a break-even age of 80. Dennis was in good health. His father had lived to 87. He decided to wait until 70. What the calculator did not include was that his pension, his IRA withdrawals, and eventually his Social Security benefit would combine to push 85% of that benefit into taxable income. The calculator he used did not account for that. Most free calculators do not. He is not unusual. This is the version of the math that most retirees run, and the error usually becomes visible the year the first Medicare adjustment arrives. Here is what the standard break-even calculation actually measures. Claiming at 62 gives you approximately 70% of your full retirement benefit. Claiming at 70 gives you approximately 124%. The break-even point in gross benefit dollars typically falls between age 80 and 82, depending on your specific benefit. That math is correct, but Social Security benefits are not automatically tax-free. If your combined income, which is your adjusted gross income plus non-taxable interest plus 50% of your Social Security benefit, exceeds $34,000 as a single filer, up to 85% of your benefit becomes subject to income tax. That threshold was set decades ago. It has never been adjusted for inflation, which means that most retirees today, with any other income source at all, a pension, a 401k distribution, even a small rental income, will have a significant portion of their Social Security taxed. Now think about what that does to the break-even. You are no longer comparing 70% of your benefit against 124% of your benefit. You are comparing 70% minus taxes against 124% minus a higher percentage of taxes. The net gap is narrower than the gross gap, which means the real break-even, the net number, lands later than the calculator showed you. For some retirees, 2 years later. For others, 4 or more. Margaret, 71, a retired school nurse from Scottsdale, built her own spreadsheet before she filed. She modeled her federal tax rate for each year of retirement, estimated how much of her benefit would be taxable, and worked backward to find the net break-even. She claimed at 68. Her net break-even was 76. The online calculator would have told her 80. That 4-year difference changed the entire structure of her plan. Now here is the second cost that most break-even calculators never include. Medicare. Part B and Part D premiums are not flat. They are income-based. The base monthly Part B premium in 2026 is $202.90 per month. But once your income crosses certain thresholds, a surcharge is added on top of that base. That surcharge is called IRMAA, Income-Related Monthly Adjustment Amount. The first IRMAA tier begins when your modified adjusted gross income crosses $109,000 as a single filer, or $218,000 filing jointly. At that point, your monthly premium jumps to $284.10 per person. At that point, your monthly premium does not increase gradually. It jumps by a fixed amount per person. Here is the connection to Social Security timing. A higher Social Security benefit added to your other income can push your combined income over that IRMAA threshold, which means the premium surcharge arrives on top of the higher taxes you are already paying on more of your benefit. And IRMAA uses a 2-year lookback. Medicare looks at the income you reported 2 years prior to set your current premium. So, the Roth conversion you did at 68, or the IRA withdrawal you took at 69 to cover living expenses while you delayed claiming, can show up as a higher Medicare bill at 71. If you did Roth conversions in the 2025 to 2028 window, which the video before this one covered, and you are also planning to delay Social Security to 70, those two decisions affect the same income line. The conversion income can push you into an IRMAA tier. Whether that trade-off is worth it depends on the size of the conversion and how long the Roth account compounds before you draw from it. Most people plan those two decisions in separate conversations. They belong in the same one. If this is useful, a quick like gets it in front of more people who need it. And here is the third piece. The third piece is the one that turns the conventional logic completely around. Most retirees assume that delaying Social Security is the more conservative choice. Wait longer, collect more, draw from savings in the meantime. But here is what that logic overlooks. Every year you delay Social Security is a year you are covering living expenses from somewhere else. For most retirees, that somewhere else is a traditional IRA or a 401k. Those withdrawals are fully taxable as ordinary income. If you draw heavily from pre-tax accounts in the years before you claim, your account balance decreases, and so do your future required minimum distributions. Smaller RMDs at 73, 74, and 75 mean lower taxable income in those years, which can keep you in a lower tax bracket, which can keep you below an IRMAA threshold entirely. But if you delay Social Security and draw from pre-tax accounts more conservatively in the meantime, those balances stay higher. Your RMDs grow larger. More taxable income arrives at precisely the moment your Social Security benefit is also at its highest. All three pressures arrive at the same time. Robert, 68, a retired pharmacist from Tucson, designed his retirement income plan entirely around maximizing his Social Security check. He delayed to 70. He drew from his IRA to cover expenses in the meantime, but carefully, trying to preserve the balance. His neighbor Carl, 69, had a nearly identical portfolio. Carl claimed Social Security at 66 and used that income to reduce his IRA withdrawals in his early retirement years, letting the account balance decline faster on paper. By 72, Robert had a higher monthly Social Security check. Carl had smaller required minimum distributions, lower taxable income, and a Medicare premium that was one tier below Robert's. Robert receives a larger monthly check. Carl keeps more of what he receives each year. They began from essentially the same position. The difference is the sequence, not the assets. The Social Security decision is not a decision about one number. It is a decision about three systems that interact simultaneously: your benefit amount, the income tax applied to that benefit, and your Medicare premiums based on income from 2 years prior. A break-even calculator that measures only benefit dollars gives you one of those three. That is not useless. It is just incomplete in a way that becomes expensive over time. The retirees who get this right are not always the ones who delayed the longest or claimed the earliest. They are the ones who modeled all three variables before they filed and made their decision based on the net number, not the gross number. The Social Security Administration's website has a tool called My Social Security that shows your projected benefit at every claiming age starting at 62. It is accurate. What it does not show is how that benefit interacts with your tax bracket or your Medicare premium tier. That part of the calculation requires either a detailed spreadsheet or a professional who specializes in Social Security optimization. And once you file, the strategy is largely locked. There are limited circumstances under which a claim can be suspended or withdrawn in the first year, but the core decision follows you through the remainder of the plan. Getting the net number right before you file is significantly less expensive than discovering the error 2 years later. Dennis spent a month on a calculation that left out 2 of the 3 costs that actually determine the answer. His break-even number was accurate, in a vacuum. Retirement does not operate in a vacuum. It operates across 3 systems at the same time, and the real number, the net number, only appears when all 3 are on the table together. That is the interaction most people miss, not the age they pick, the gap between what the calculator showed and what the plan actually costs. If the next question in your mind is how to run all 3 of those variables at the same time before you file, that is exactly what the next video covers.